Hey traders, Raghi here. We're going to kick this off with a scan of the Dow. Now, for the past three previous premium videos, starting with Wednesday when I officially shifted to a bullish bias, one of the things that we wanted to start doing is also taking advantage of the fact that one, we want to day trade in a bullish direction as the priority. That doesn't mean that we're never going to short again, but boy, it's got to be a heck of a setup off the resistance levels that are low risk and etc. Will we end up with days like Thursday from time to time? We will, of course, but again, we're not looking at, well, Thursday was a big short. It was really, if I'm taking the entire month and looking at all the days where I bought and stuck with a long side and all the days that I shorted, you're going to find that your shorts are going to get stopped out at a higher rate because the market still does have a path of least resistance to the upside. Now, did Thursday rattle some bulls? I believe it rattled them, but I think that the Federal Reserve stepped in and said they're buying more junk, and here we go again with the Federal Reserve continuing to support specifically the stock market, communicate to the stock market that we're not going to just let a day like Thursday happen without our retaliating with mo money, right? That's huge, and that's, I believe, what's going to keep the path of least resistance to the upside. I mention that because without that understanding of my bullish bias longer term, I hate to say the word faith in the Fed, but yeah, my faith in their ability to continue to pump this market up, yeah, I feel pretty good in being a buyer on pullbacks. Not to mention, we are not indiscriminately buying. We are buying specifically in markets that have given us sort of the green light, literally and figuratively, to be buyers. UNH is not my preferred buy, but it could be an oversold buy. But it's the double greens that we're going to continue to focus on, as we've talked about. So yes, after Thursday, there may be a number of markets that have lost their double green standing. If you are long one of these markets that was formerly double green and now it's, say, yellow or green yellow, don't worry about it. Play the trade out. Yes, if you decide at this point you want to get out of it, that's fine, but I want to remind you all about something in terms of market structure, straight from the 140-year-old theory, Charles Dow theory, and that is this. A broken trend, in this case a broken uptrend, once this transition happens, is not a downtrend. I think a lot of folks still in this market environment, and really in any market environment, believe the markets are sort of binary. If it's not moving higher, it's moving lower. No. In fact, a broken uptrend is actually distribution, which means that it still has a bullish bias and it's simply choppy now, and you're still going to look for buys, which is what UNH would still be. So if you're in UNH, that's fine. If it was a buy for you earlier, that's absolutely fine, because the path of least resistance, the directional bias, may not be a trend, but it is bullish. And that actually brings up a good point. You can have bias, right? You can have bias, meaning directional bias, a preference to be long versus short, or vice versa, okay, but not have a trend. Okay, case in point, I was just showing you UNH, heavily weighted stock within the Dow. So for sure, I don't want to prioritize this name, but it's not a short. Do I want to prioritize pullbacks in Home Depot? This was a question that was asked of me in the chat room, and the question was, can we buy Home Depot? And I said, absolutely. On the way down into the wave. So the bearish momentum is key. So a lot of folks ask, well, Rog, do I have to be short? Do I have to be buying the put or the long or the call? In this case, a call. Right? Do I have to be buying the put or the call at simply the price level? No. In this case, you have to buy the call, which would mimic a long position in Home Depot, as the market is selling down to the 34 EMA on the high, close, or low. Either one of those three, and or, quite frankly, the high, the close, and the low. As long as the momentum is bearish, as long as we're pushing lower lows. If you're wondering, Rog, what does bearish momentum mean? At the point that you are looking to enter your bid to buy the call, the underlying futures, the underlying stock, the underlying ETF must be pushing at lower lows. That's bearish momentum. And in that environment, we want to step in typically at the bid or split the bid offer and try to buy the at or slightly in the money call in Home Depot. So you might say, Rod, what does this have to do with futures trading? Well, if you've been following me along for the past couple of weeks or even the past few years, you know that trading the YM is trading a bunch of stocks. It's a bunch of stocks. Inside the YM futures, inside the ES futures are a number of individual stocks. So this is a lot of what we talked about last week. Now I can take this YM conversation and carry it over to the XLI. We could carry it over to the IYT. These are sectors that are heavily weighted within the Dow. Now think about why we like index futures. It allows us to trade stocks, sure, but it also allows us to take advantage of the leverage. Well, if I like to trade groups of stocks, well, then I can trade ETFs. If I want to replicate or get a piece of that kind of leverage, not necessarily the same awesome leverage of futures, but if I want to take advantage of a group of stocks to trade, like ETFs, and I want the advantage of leverage, like I get in futures, options are a really good second choice. Okay, and in some ways, they're going to be a better choice depending upon the group of stocks that you're looking to trade, because I cannot trade XLI futures. Now, the funny thing is, if you head on over to the cmegroup.com, you'll notice that we do actually have sector futures, but nobody trades them. Folks trade the ETFs. That is the more popular way to trade these sectors, these smaller groupings of stocks. I shouldn't say smaller in terms of numbers, but smaller in terms of impact, a particular sector versus a broader average. There are sector futures, and there's no liquidity, there's no volume, which is really a bummer, because I'd much rather be talking about the XLI version of the futures contract. But until that day happens, we are going to end up focusing on the ETFs. So I jump on over to the XLI, and the first thing that I want to do is just make sure that the current layout of the stocks is in line with the current weighting. Now, I'll check this typically on a Sunday or a Monday, so I'm aware of the order. So there's a couple change ups here. It's usually not going to be major. I want to show you how subtle it can be. Honeywell is now number 2. Boeing is now number 3. RTX, LMT, 3M, UPS, CAT, GE, CSX, everything else is the same. What you're going to notice is slight shifts. And again, ETFDB, okay? ETFDB.com. Look up the ETF, click on the holdings, and you can make sure that you're trading the current weighting of this ETF. All right, once we get that done, this is a piece of the YM. It's the industrials. Double greens? Yes. Double green here? Absolutely. You can trade the broader sector via calls on the XLI on pullbacks, Thursday, Friday, even earlier this morning. If you recall in the premium video when I gave everyone sort of the setups of, hey, let's focus on the double greens and let's focus on Monday, admittedly, the window of opportunity was very, very narrow. It was early this morning that we were trading down into the zone. I wanted to wait till Monday to see how much lower we might go. I think we might have gone and stayed lower for a little while longer had the Federal Reserve not made the announcement about buying more bonds, more individual corporate bonds to bail out individual companies, because that's, of course, the Fed's job, right? Do you hear the sarcasm dripping from my mouth? So, yes, that's actually going to make the equity markets rally. UPS, Caterpillar, 3M, CSX, Boeing, UNP, XLI. The week before last, I had mentioned the transports. Now, if you're a Dow theory fan and student, as I am, you know how fondly and importantly Dow emphasized the transports. So we started talking about the transports as an alternative to trading the Dow until the pullback came. And this particular layout is exactly the same. Pullbacks on IYT, yes. Pullbacks on NSE, UNP, KSU, A lot of these are still valid. In fact, at the time, Landstar looked really good too. Landstar has since gotten very choppy. So for those of you that might be in Landstar thinking, Rog, what the heck is going on? If you've got the options, you've sort of shielded. You are sort of shielded from the volatility because the option is, yes, going to move, but in a way that's not as dramatic as the underlying. And we've got time on our options. Remember, we're always looking minimally 45 to 60 days out before expiration. So this kind of stuff is a lot of noise within the context of a market that I do not have a trend in, but I still have directional bias in. I still feel it's a bullish market, but it's on a trending market. What's a trending market? Well, look at all the double greens. Double green pullbacks are the priority. So again, if you're in one of these markets that's gone yellow, don't worry about it. You've set this up with time. But the common question I get is, Rob, do I or can I buy more, say, LSTR? I would not recommend it. And here's how I would tell you to look at it. If you wake up one morning and you see a stock that you own or option on a stock that you own is underwater and there might be, you're thinking to yourself, well, let me buy more. First of all, don't. Look at the market as if you do not own LSTR. Start with a blank slate. Even though you have positions clearly in your book, start with a blank slate and ask, if I were putting capital to work today, would I put it in LSTR? Take away the bias of already having it. Take away this desire to sort of dollar cost average and all these other things to try to make this current unrealized loss a higher probability winner. Stop all that. We still have a high probability winner without adding, quote unquote, adding to this position. I don't like the word add. If there's a secondary setup, then there's a conversation. I don't think LSTR has another setup until we get clear down to the area that is with this Darvis right here, this Darvis area. I don't think we even have a level until this area right there, right, just below 100. Okay, so there's not even a secondary setup to take advantage of. Imagine you don't have any positions and ask yourself, what would I buy today? It would not be LSTR, would it? It would be markets that are double green that are pulling back into the wave. So don't let the bias inherent with having an open position dictate what you might do. All right. So some of the strongest parts of the market have continued to be tech and names that are related to the NASDAQ and to the S&P. So that brings us to things like XLK and XLC and XLY. Now, XLK is a tech version of the QQQ. I say a version because Microsoft, Apple, Visa, MasterCard is now number 4, then Intel, NVIDIA, Adobe, then we have Cisco. You got to know your weightings, you got to know your weightings. And so again, just a quick stop at ETFDB and you see, okay, these haven't changed all that much. A couple shuffles, that's it. Even if you hadn't done it, you're not looking at the wrong names. 42.5% or so of this entire ETF is Microsoft and Apple. XLK is going where Microsoft and Apple are going. Now, one thing you might notice is there's one huge name, a couple huge names missing. Where's Google? Where's Facebook? And where's Amazon? XLK is the part of the NASDAQ that is really very much emphasizing Microsoft and Apple. So if you say to yourself, wow, I want a little bit of an SMH type exposure, semiconductors, along with specifically Apple and Microsoft because they're outperformers, I would tell you trade XLK. If Google, Facebook, and Amazon are underperforming, you'll have a better shot at tech if Microsoft, Apple, and semiconductors, SMH, are outperforming. Then trade the XLK. Now, if you head on over to the XLC, you'll notice where some of those names reside. And again, just do a quick check of the weighting, and you'll notice a few things. Once again, prioritizing individual stocks. Sometimes you're going to find certain alternatives to the NASDAQ futures are going to be best traded through some of these ETFs that allow you to emphasize certain names. If Facebook, Goog, and Google, okay, are outperforming, you're going to want to take a look at the XLC. If Facebook, Goog, and Google are the ones outperforming, then you've got some quirky names that you typically don't probably think of as part of the NAS, names like T-Mobile, Electronic Arts, Activision, although a lot of people are very interested in these names. Disney is up there, Charter, okay. Netflix, a lot of folks love trading Netflix right now, very popular quarantine stock. And then Verizon, VZ, and this is ATVI. All right, so again, not a lot of new names, but a lot of shuffling up, as you can see. So just make sure you've got the right order. Now, here's what I'm going to say. When you're looking at XLC, over 45%, or right around 45%, and almost 50% of this XLC ETF is Facebook, Google, Goog, and T-Mobile. The top three, Facebook, Goog, and Google, are about 40+%. I think it's like 43%, almost 45, okay? 45% of where XLC goes is this top row of stocks right there. So if you're looking at the NASDAQ and you're seeing Facebook, Goog, Google outperforming, don't trade necessarily the XLK, beeline for the XLC. All right. So both of these, as you notice, omit Amazon. Amazon's been on a tear. So if you want exposure to Amazon, you would play Amazon directly, clearly, or you would then go to the QQQ. So it's really important to understand these weightings, and what this allows you to do is kind of get very specific and tactical about what you want exposure to. If you want exposure to EA and Activision, much heavier within an ETF, EA and Activision are almost 10% of XLC. They're much lower in other versions or other NASDAQ-like breakdowns. If you want exposure to video games, EA and Activision, XLC is going to be a really good way to express that opinion, especially if you are also simultaneously bullish Facebook, Goog, and Google. Really important, okay? And this is how a futures trader takes what they know about the futures markets, specifically futures index contracts, and says, well, how are other ways I can break this down and use leverage? And that's what we were leading up to all last week. Am I still a bull in the stock market? Yes, I'm going to acknowledge that a lot of other buyers got shaken, but I don't think they've gotten shaken to the point where we've broken the uptrends. Sector after sector, index after index, what are you seeing? The double greens. Gang, I cannot short these names. I will not short them, and you'll see that those buys we were waiting on today happened earlier this morning. I was kind of looking forward to these markets lingering a little bit lower, maybe through Monday, and rallying on a turnaround Tuesday. That would have been ideal, but that's not what we got. But I asked everybody to wait for Monday. We did get the lower lows, but the window, the ball sailing across the plate to us, the hitter, was a very small window indeed. But this is where we prepared for days in advance of today. And I hope, by the way, this won't be the last pullback opportunity. No way. So, now that you understand what I'm doing and why I'm doing it this way, this should be, moving forward, a whole lot easier for you to trade the next time we get this opportunity. Now, I want to kind of wrap this up with a Amazon look. So Amazon, Home Depot, by the way, that Microsoft was an error. That was just something I had changed out when I was looking at an individual stock. So Amazon, Home Depot, McDonald's, Nike, Lowe's, Starbucks, Booking, TJ Maxx, Target, Dollar General, and eBay. eBay's just kind of leapfrogged General Motors. So that's not a huge shuffle up, gang, because eBay is 1.69% of this. General Motors is 1.63, and you'll see the two of them sort of go back and forth for 11th place. 11th place, okay? 24% of this ETF, the XLY discretionary, is Amazon. If you want like a diehard, sort of nearly all-in type play on Amazon, this is it. This is a really interesting breakdown, because Amazon is a tech stock, but it's sort of lumped in here with this consumer discretionary. And I like this particular exposure to Amazon. through the XLY because I actually like and am long Nike and Home Depot. I don't like McDonald's, but I don't think it's going to be a huge problem. I'm not crazy about Starbucks. I think they might be laggards, but Lowe's, Home Depot, Amazon, and Nike will not be. Booking might be a little temperamental. People aren't necessarily traveling the way they are. But Dollar General is terrific, and so is eBay. So I like this, but remember, a full 25% almost of the XLY is solely Amazon. When you add Amazon, Home Depot, and Nike, I'm leapfrogging McDonald's here, you've got 24%, 12%, and about 5.5% of this index. And I love those names. You tack on Lowe's, another 4.5%. These are names I really, really like, and I think they'll outperform or at least make up for any lagging we could see in booking McDonald's and Starbucks. So this is another very interesting ETF, especially if you're playing some of the retail plus Amazon, not as a tech name, but as a retail name. And XLY is one of my favorite names. And remember, XLY is a heavily weighted sector within the NASDAQ futures, as many of you know. So this is the second heaviest or third heaviest weighted sector. Think of it as XLK, XLC, and then XLY. So this is like a piece of the NAS. I know this video has gone kind of long. Really wanted to tie all this up for you guys. We'll talk more about this throughout the week, and I'll see you in the next update.